Hello, I'm James Yardley, and today I'm joined by Gary Kirk, the fund manager of the TwentyFour Dynamic Bond Fund. Now, 24 is regulated by the FCA and deals with professional clients only. Thanks for joining us, Gary.
Hi, good to be here.
Gary, let's start with inflation. It's the big subject of the day, of course. What's your view on it? I mean, is it transitory or is it here to stay?
Yeah, you're absolutely right, James. To start with that question, it is the key factor that is driving market participants and their thought process at the moment, and it has been that way for some time, certainly since the spring of this year, and it has now become, the one sort of key factor that everybody is focused on all the time. And obviously, this week is a key week because we have, the central banks, sort of meeting, and we're waiting for the comments from the Fed, which is going to be tomorrow. They meet today and tomorrow, and then of course we've got the Bank of England on Thursday. So all eyes and ears from the market participants is going to be on that. Is it transitory or is it fundamentally baked into the economy? It's the one question that we all keep asking. Nobody really knows the answer yet. I think initially, market participants definitely went along with the central bank rhetoric, which was, don't worry about the spikes in inflation. However, I think that transitory is one of those terms that nobody really knows how long transitory actually is. And this has now been the central bank rhetoric for a long time. So I think that people now are becoming a little bit more skeptical about whether or not this inflation that we're seeing is purely transient in nature. I think more and more people are beginning to think that not all of it is, and that some of this inflation that we're seeing at the moment is more permanently baked into the economy. And
one of the things we have started to see more is more wage inflation, which I know worries the central bankers more, and maybe inflation expectations starting to rise as well. Are there any sort of key indicators like that which you're looking at in particular?
Absolutely. With obviously the Fed are the key players here. I mean, they're the ones that drive, the sort of the global market really, and they've got a dual mandate. And the dual mandate of the Fed is for employment, right, to sort of maximise full employment, and of course price stability. They're the two key, i.e. inflation. They're the two mandates, or the dual mandate, that the Fed has, and quite rightly, or I guess that after or during the pandemic, the key was actually making sure that employment was brought down to an acceptable level, and they were prepared to let inflation run hot whilst focusing on getting jobs down. And that is, still a key issue. However, it's a dangerous game to play when at the moment we've got about 4 to 5 million jobs still to sort of find for those consumers that are in need of permanent employment. We need to get that, or the Fed are aiming to get that down to about 4% unemployment rate. So that works out to be about 4.5 million jobs. However, the participation rate is one that's very low at the moment. And participation rate is those number of people aged between 16 and 64 that are either in full employment or looking for employment. That number's very low at the moment, which is a little bit of a nagging, while the market is having a little bit of a nagging doubt about whether focusing on this last 4 or 5 million is actually what the Fed should be doing. Because it may well be that COVID has actually psychologically changed a lot of people who might be coming close to that 64-year-old age, will no longer look for a job because they've got enough savings, and they've sort of all right, I'm not going to bother sort of even looking for a role anymore. And some of the younger people that may be a little bit more, well, let's just give it another year, and I'm in no rush. There are a number of reasons why that participation rate may be low. That creates a problem in the fact that there are a lot of jobs on offer at the moment to the tune of about 10.4 million. Now, the net effect of that is wage inflation begins to go up because there is a shortage of labour in certain areas, and it's self-fulfilling. the more that credits and entities are looking for their extra workforce to increase the workforce, and the participation rate stays low. People aren't really rushing back, and there are a lot of jobs out there being on offer. It means that you have to increase the wages in order to attract those people into jobs. And we've seen all the headline numbers, Burger King and all these people trying to give cash inducements for people to come and work for them. Haulage drivers being offered tantalizing sign on for 5,000, which is taking people away from bus driving into lorry driving. All those things are driving wage inflation. And that's a problem, because wage inflation can be self-fulfilling. And if you have runaway wage inflation, ultimately it feeds into the wider economy. And then there is no question that that inflation will not be transient. It will be baked into the actual economy. So it's something that really has to be controlled by the central bankers. And here in the UK, we've seen inflation running very high. We've heard, we've all seen the news, and we've read the seen the media with the shortage of haulage drivers, port workers, Weatherspoons saying that they can't now get the number of staff that they need. All this is actually quite concerning, and I think that it's a fair reason why the MPC, the Bank of England, are probably more hawkish than their peers at the ECB and or even the Fed come to that. So there is. It's a $50 billion question, about that. Is it transient? Is it more baked in? We don't know the answer, but my guess is, unlike the central banks are telling us it's all transitory, I think that some of it is a little bit more permanent now.
Really interesting. And can you tell our viewers why inflation matters for bonds and why it can potentially be negative?
Inflation generally is the scourge of fixed income investors. Going back to when I first started in the bond markets, it was I kind of think of a bond as being a series of fixed future cash flows. Typically, a bond it pays you coupons normally, and I say that normally, typically on an annual basis. And then you get your money back on the redemption date, on the maturity date. And those fixed coupon payments are fixed at the time you buy them. So if we have constant inflation, then it's clear that the purchasing power of those cash flows, of those annual coupons, will be reduced. So to make it really simple, say that we invest in a million bonds at a new issue, and it pays a 6% coupon. So in a year's time, I pay my £1 million, I buy my bond, and that 6% coupon, that pays me £60,000 after year one. Simple. Now that £60,000 has a certain amount that it can buy. But at the moment, take any asset, a car. So that investor decides I'm going to buy myself a new electric vehicle. It costs £60,000. So my one coupon will buy that car. Easy. However, when there's inflation, the next year down the line, Mr. Smith with his 60,000 coupon coming in decides I'm going to buy another new car, or replace the car. But inflation has increased the price of those assets, so we've increased the price of a car. Now, at the moment, new cars are going up, 8, 9, 10%. So that 60,000 car that you bought with your first coupon, the next year, it's gone up, say 9%. So it's actually gone up to £65,500 or thereabouts. But you investing in that fixed income bond will only get another 60,000 your next coupon. So you're £5,500 less purchasing power than you had the previous year. So you can see that inflation eats away the actual purchasing power of your bond. So bond investors will say, well, hang on a minute, this isn't right. I demand a higher yield because inflation has gone up over the year. And as we all know, as yield goes up, price goes down of a bond. There is obviously a sort of negative correlation between yield and price. And so therefore, if investors demand a higher yield for that bond because it has less purchasing power, then the price has to go down. And that's why inflation has a negative impact typically on fixed income.
And yes, we are now sort of expecting interest rates to go up in the UK pretty soon, I think, and perhaps later, as you say, in the US. Is there a cap on how high those rates can go? I mean, we've all become so used to this low interest rate environment. I mean, there's a question of how much we can really take in terms of interest rates.
Absolutely. I mean, I think this is the balancing act that central bankers will have, because, you know, if inflation is more baked into the economy, then they need to raise rates to curb that inflation, to temper it down. However, they don't want to raise rates too fast, too hard, in order to choke the economic recovery before it's really got going. And remember, we're not even back to where we were in sort of pre-2019 levels. So, you know, yes, we've had a quite a rapid recovery from the depths of the COVID pandemic, but we're still not back to where we were in 2018, 2019. So it is a very, very difficult balancing act of what the central bankers do from here. Now, one of the other things that's been is almost unprecedented in this particular cycle is how much momentum, how quickly this cycle has turned. And I'm talking about the credit cycle here. We've gone from recession in Q1 2020 into the recovery sort of phase, and now we're really in a mature phase, or sort of, I would say, sort of a medium to mature phase of the credit cycle. The rate cycle is obviously behind because we haven't yet started the rate increase, but unlike the last rate cycle, which was, I guess, 2015 to 2018, the Fed got away with about 9 rate hikes. This time round, by the time they start hiking rates, which will be probably at the earliest, the end of 2022, I think they will be lucky if they will get in 6 or 7 rate hikes. Maybe Fed funds, which are currently 0, will get to sort of 2%, maybe. I think they'll do pretty well. Here in the UK, in the last rate cycle, we were hampered in the middle because of the EU referendum, which was obviously in 2016. So we didn't get the number of rate hikes away, the Bank of England, like the Fed did. This time round, I think the Bank of England will be the first to move. But I would still be surprised if they moved rapidly and if they moved in large size. So I think that it will be incremental increases in the base rate. There's a 50% chance they move this particular week. I think they'll probably do it in December. I would still be very, very surprised if the Bank of England could get base rates much above 1.5% by the time they have to then halt or even begin to reduce, i.e. when the cycle sort of turns. So, you know, if you think about a base rate of maximum 1.5%, that would put 10-year gilts, which is the benchmark that we all look at, you know, for where corporates typically borrow over, 2% would probably be, you know, the right sort of level. So it's about 100 basis points from where we currently are in the marketplace. So I think the market is a little bit ahead of the central banks here in where they sort of ascertain when rates are going to start to move and where they will probably finish up. That said, 100 basis points in the 10-year still equates to about 8.5 points in price. So still not the trade that you want in your portfolio yet. You wouldn't be buying gilts, you wouldn't be buying US Treasuries at this stage of the cycle.
Yeah, so coming on to your fund then, so you have the advantages of a very flexible mandate. Mm-hmm. How are you able to make money in this environment? What are you doing at the moment?
Well, I think the first thing is, typically we would normally want a balanced portfolio. We'd want some rates and we'd want some credit, you know, as a bit of a balance. But at the moment, as I say, having a strategic position in rates, in government bonds, it's just not viable. So therefore, you know, we think there's far too much volatility and headwind to come. So therefore, you know, we don't have any exposure to duration, and we don't have, you know, we don't have any exposure to rates, government bonds. That's first and foremost. That said, we are still going to, you know, fixed income bonds are still going to have some contagion effect when duration, rears its head and rates go higher. So it's important to position the portfolio in a defensive sort of positioning. So therefore, the obvious thing to do is to avoid long-dated bonds, because the longer the dated the bond, the more duration sensitive it is going to be. So we want to be at the medium to shorter end of the credit curve of the maturities, and we also want to have a number of credit spread basis points. We want some spread built into the portfolio to compensate us for the likely increase in rates, which will then go along with a likely increase in the volatility. So we want to avoid typically investment grade bonds that are very, very correlated to government bonds. So we want to be in sub-investment that typically will trade off of their own price, as opposed to being highly correlated to the government bond level. So that's important. But we don't want to be in too highly speculative credits at this particular point in the cycle as well, because as we get towards the late cycle, it's those highly speculative credits that typically will be the ones that face solvency issues. So we want to be in just below the investment grade, typically around the crossover level, where we want to be relatively short dated with an element of credit spread built in. That's where we've got to be targeting. It's not going to be a period where you're going to make massive returns, but if you have a relatively attractive level of credit spread with a relatively sort of short maturity profile, then you will be able to ride this sort of period through quite nicely. Great examples would be something like the subordinated bank sector. There will be some volatility there. We totally accept that. However, this is a very, very broad sort of spectrum of bonds. There are a number of different structures in there. You have sort of high coupon bonds, low coupon bonds, long calls, so long sort of maturity to the first call date. You have short maturity calls. You have those calls that are either going to be in the money or out the money, a vast array of bonds to choose from. And by doing your due diligence, you can select the more robust names, slightly shorter calls with attractive credit spreads. That's going to give you some protection over the medium term. And then, of course, we also look at other sectors of the market which will protect us very well. The most obvious one are those credit bonds that are floating rate in sort of nature. They're the ones where the coupons refix either every month or every quarter based on an underlying index, typically money market swaps. And so therefore, when inflation increases, rates go up, the swap rate goes up, and your coupon goes up. So therefore, you're protected that way. And asset-backed securities, ABS, is typically structured in this way. They're structured as a floating rate note. We particularly like European CLOs. These give us exposure to leverage loans, but in a bond format, in floating bond format. And they have normally an attractive credit spread, typically because of the complexity premium that's embedded in them. They typically reset on a quarterly basis. So at this particular point in time, they're actually offer quite a high degree of inflation protection that's actually built into them. So I would say that that's really where we're looking at. Floating rate note where we can find it, and where we can't, around the crossover type rating, so they're less sensitive to duration, with a high degree of credit spread margin built in, and hopefully at the shorter end of the credit curve. If you focus on that, then the portfolio will actually perform reasonably well.
Brilliant. Well, that's been really interesting. Thank you very much for joining us today, Gary.
Not all, always a pleasure. Thank you, James.
And for more information on the 24 Dynamic Bond Fund, please visit chelseafs.co.uk.